Go. Welcome, Ray. Thank you very much for joining me this morning. This is Ray Tammam, who is a chartered financial planner at Fairstone Group. And we're going to be looking at a very common scenario this morning involving people who are selling their business in terms of the new financial realities which will be hitting them, and with the things they need to think about, Ray. And I'm sure many of these things have come across your desk throughout the years. So just for the avoidance of doubt before we start, what they normally call housekeeping in the traditional seminars, when people used to go into buildings together, we're not giving any tax advice or any individual financial planning advice. Ray is, of course, available for people who want to get in touch with them for a free, no obligation interview. We'll give the details at the end. Just like to mention that it's within the context of this conversation, I have an accountancy background. It is very important that accountants get involved in this process collaboratively with people like Ray and people like myself who do the brokerage and the business transfer side early on in the client relationship if possible, because again, as we know, Ray, if a professional's giving advice, all well and good. If they're not giving advice that they should be giving, and the client finds out somewhere else, which they invariably will find out somewhere else, they will go to that somewhere else. So by way of background, the typical kind of business and client which I'll be dealing with and you'll be seeing is someone who's got a successful established business, perhaps worth £1 million, £3-4 million, an owner shareholder working full time, and it's got a nice comfortable lifestyle, pulling out the business excess of £100,000 a year, perhaps a couple of £100,000 a year. So got, for what the average person will need to live comfortably, I think they're home and dry. So this is the background, Ram. You see this obviously in your daily work. Now, there's issues which arise. There's 4 issues which I think would like to discuss today. One is do you find that your clients appreciate that one day they will need to or want to sell their business? Do they see it coming down the line? What's your experience there?
It's a good question. I think people have it in the back of their mind. They want to sell one day. But I find that in most cases, people are so busy in the business that sometimes haven't got the time to take a step back and think, and then someone might come in suddenly with an offer, and then they have to decide, obviously, if that's a good offer or not. But I think it's fair to say not enough people actually stop and think, okay, in, for example, 3, 4, 5 years' time, I think that's the time I would definitely like to sell, unless I get a great offer in the meantime. So I think I need to do some planning. But I think that's really important, Norman, the people trying to plan ahead. I'd say a minimum of a year, ideally probably 2 to 3 years in advance of any sale to get that professional advice.
Yeah, a year at the very least. And of course, some businesses, this is out with your scope, but some businesses from where I sit at the table, they're going to need time to actually fix potential issues and problems which they might have within their business. Now, when you bring the subject up, what sort of reaction do you get from your clients?
I think it's a little bit like when I say to people generically that they should have a will or a lasting power of attorney, or get some insurance in case, God forbid, something horrible happens, and they almost hold their hands up and go, okay, I'm guilty. I know I really should be looking at those areas, but I haven't because I'm too busy, or I don't like to think about it, as it might be. So there's a definite, I think people know it's in the back of the mind, but for people to take the time off to think, right, I'm going to take a week off now, or a couple of weeks off to really plan. It's very difficult when you're heavily involved, as you say, in the example of being a full-time person in a business. You're really busy with the business and you take it home with you as well. So I think it's that almost admission of, it's almost like being caught by the police, I think. Okay, okay. I've been caught out, I know I need to plan, but it's just not happened. So I think they actually appreciate a bit of proactivity, whether it's an independent financial advisor like myself, or on the accountancy side, or on your side. I think people actually appreciate being told you really need to start planning, and it can make a massive difference as well to the valuation. As you said, Norman, filling holes to actually get people in to look through and whether it's the books up to date, the records, the CRM system, if they're not up to date, you're not going to get as much money as you think. If everything is bang on and can be taken over very easily, and the staff can stay on, etc., etc., the easier you can make that, you're going to make yourself a lot more money.
Absolutely. Yeah. Sometimes they don't see the wood for the trees. They don't realize there are cracks in the foundations, because they are making money. A lot of the businesses will be trading on historic goodwill, but markets change, and people's preferences, what they want to in the business are going to change. That's very interesting. It's just something obviously which I do come across as well. They come to me and they're just not ready to sell. Well, they're ready to sell, but the business is not what we call sales ready. Do you find they've got a reasonable understanding of the market realities of what their business is actually worth, not what they want it to be worth or what they need it to be worth to maintain their lifestyle? Because I find that very often they've got this unrealistic expectation, because it's a case of Chinese whispers, that they've heard about someone in their golf club or their social circle. They don't know this person, they've heard about them, and they sold for a multiple of 10 times, or they've opened a newspaper and seen that Uber or one of these sort of Deliveroo have been floated for ridiculous valuation, and they don't make any money, and they think they're in the same category. Do you find that?
Yeah, I mean, absolutely. I think it's, again, a little bit like people selling the house. They're usually quite disappointed, I think, when they find out the reality of the sales price compared to what they think it's worth based on the vague neighbor that they heard about from a few years ago from a friend of a friend. So yeah, it's exactly the same thing. I think people must get independent valuations, and even ideally more than one person to get an independent valuation. The same again as property. That's why you get 2 or 3 estate agents round, is best practice, not one, and to actually get an idea of the valuation. Because if you're planning retirement hoping you're going to get 3 or 4 million quid, and in reality it's 1 million, then that's quite a difference. Of course, it can go the other way as well, but I tend to find that unfortunately it's people getting an idea that it's worth rather more than, unfortunately, it often is, which, again, back to the previous point. So again, even more important to get everything as saleable, as you said, Norman, sales ready as humanly possible to maximize what they're going to get.
Yeah, the property analogy is always a good one. They say location, location, location. You might have a beautiful house, but there's a limit in this street how much premium you're going to command. And it's the same with the mundane business. If you're making widgets, widget manufacturers will typically sell for a multiple of, let's say, 2.9. And so you might be able to squeeze, 3.2 or something if you've got a compelling story that your widget is a better widget. And but it takes time for people to wake up and smell the coffee. That is the problem. I found that when selling a business or engaging with people, if I'm the first agent they talk to, very often they'll be so disappointed when I tell them that, we sold one down the road, or we sold one similar last year, 3 weeks ago, and this is what happened, this is what it's worth, and they don't want to hear it. Whereas if I'm the second or third agent that they're phoning up and I'm telling them the same as the first two, I'll get the business, because they've already been conditioned. So this is a bugbear. Do you think there's anything we can do as a profession, as our in our respective professions, to educate people about this kind of thing?
I think it's a good question. I think, giving some actual figures that, a typical so-and-so business works on 3 times a multiple, and just almost trying to publicize that as much as possible, to try and give an idea that it's not going to be 10 times, and just to try and publicize that is probably not the easiest way of doing it, but going through, I know both of us do a lot of work with accountants, and making sure perhaps they're involved, quite any remote discussion that they're involved in early on, that they're hopefully knowledgeable about, look, in your type of business, it's approximately, and if they're not sure, speak to someone like you, to come and get an idea, because most businesses will fit into, as you say, an approximate multiple spacing of valuation, and it's unlikely to be wildly different. Now and again, there will be a freak one that gets much higher. Unfortunately, there's some that will get lower, but I think it's just trying to publicize a realistic expectation.
Right. Now, what the third item is that this is something which is probably the most fundamental question to get a balance right. And this balance is turning off the income tap of this business. As we said, they've got a lifestyle, they're living nicely. Yeah. Turning off this income tap against the danger of waiting too long, leaving it too late. Too late meaning that they might become, they have the same strength to, to run the business anymore. It could be that there's technological changes coming or legislative changes coming down the line. Or anything could come, 2 years ago, who would have imagined COVID coming to shut the world down? Even though if you ask anyone in the medical and professional and scientific fields, they'd all said the number one threat to the world has always been pandemic, but we've been fortunate for so long not to have experienced it in the same way that's happened now. So this is a very hard balance to get. So if you're 70, you can understand, but if you're 55 or 60, and you need to make this decision, this is a very tricky one. Are you going to have a second bite at the cherry? You're not going to start a new business at 60, are you? 55 maybe, but you haven't got the same drive and energy as you might have had 30 years ago. So how do you explain this and advise the clients and these sort of things?
Yeah, I mean, it's a very good point. Again, I think it goes back to the planning. People need to think of, if I'm selling at 55, I'm selling at 60, what do I want to do? Most people do want to step away and, they might do a bit of consultancy, but they're unlikely to go full time into another business. So that's where it's so important to get as much as they can, and obviously use someone like myself to get that invested to try and maximize potential returns from their money, so they can perhaps draw an income from that, and then anything else is a bonus, and they'll probably quite enjoy working one or two days a week.
So sorry, how you were going to explain to me now how you have this conversation about the balance of leaving it too late against turning off the income tap?
Yeah, so I think that goes back to the planning stage, as trying to look at, a year or two ahead at least, and have a good think about, do you want to go and work full time somewhere else or start a brand new business, as it were? I think most people tend to want to just take the capital lump sum. I would advise them on, how best to invest that to produce income. Often that can then meet their standard of living that they're happy with, and then they may choose to do 1 or 2 days involved in another business or on a consultancy basis, or just simply enjoy lots of holidays. But I think people do need to think about, if they're 60, 65, 70, would they really want to go into another full-time role or a part-time role? Again, it's just part of that planning. But I think 1 or 2 areas to sort of think about now, really, and plan ahead. It's never too early, to make sure, as key people in the business and shareholders, you are insured. So if, God forbid, something happened and you or another shareholder passed away or had a critical illness, such as heart attack, stroke, cancer, something that's likely to keep you away from the business for a long time, if not full stop, have you got the correct insurances in place to make sure that the business would receive money to replace that person? Or is there other key members of staff who, if they disappeared tomorrow, would cause a big issue? So protect the value of the business by actually making sure they're insured. Equally, make sure you're maximizing your pension arrangements. It's incredibly tax efficient, and there's some really good opportunities available, particularly if you have a limited company, to put some serious money away, which will of course help as part of the solution after you stop working. But there are limits, so you need to get advice on how best to do that, because once people stop work, I've had this quite a few times, people have stopped work, maybe sold a business, and then they've heard about all the great tax advantages of a pension. They've got a lot of money sat in a bank and want to put money in, not realizing that if they're not actually earning a salary, they can't pay into a pension anymore.
Right.
So it's a catch-22. Right. So it's trying to do that again in advance, part of the planning. Let's maximize the money in there, and if you can get a load of tax back at the same time, then that's obviously important on both our sides to help people to try and minimize tax as well.
So is that part of the equation about this balance of shutting off the tap which provides the income and selling now, or soldiering on for a bit longer? So you say soldier on a wee bit longer, perhaps take advantage of these tax breaks. But when push comes to shove and they have to make that choice. So, someone says to you, Ray, okay, I understand the business is going to get me £2 million. So £2 million, I'm going to have £2 million in the bank. Let's say we're paying tax at 10%, or the relief for argument's sake as it stands now. So got a 1.8 million pounds. Am I going to get my annual income that this business was paying me of £300,000 out of 1.8 million? Answer is probably no, you're not. So how do well, we're not giving advice here as such, yeah. But yeah, no. So how do you deflate them and explain to them that it's, you're going to have to cut back on the cruising?
Well, yeah, I mean, again, it's a good point. And again, it's linked back to it's the common theme here of the planning. So early conversations, as soon as we've got a good valuation, and obviously you can help people with that. And we come in and it's, let's use a round figure of £1 million, £1 million, it may, one of the first things we would always do on our side is to go through, well, look, that's going to give you an estimated sensible return of X. How does that sound? And we would go through someone's current expenses, but also look at their likely expenses in retirement. Usually, this is talking generally, if the people have got kids, they're probably grown up and gone. If they've got mortgage or mortgages, they're probably being paid off. People don't need as much money in retirement, so that's okay. But again, like before, you don't want that huge drop in retirement. So if you're getting £1 million, that may give you, and I'm not giving a specific piece of guidance here, but it might be something sensible like, say, £30,000 a year, as an example, using 3% at the moment because interest rates are very low. But as a very broad guide, that probably isn't a million miles away from a sensible amount to take from £1 million pot at the moment. So 30,000 a year when someone's on six figures, that's quite a drop. Yes, you're only going to be paying basic rate tax at that level, which helps, not high rate tax, but that is a drop. But people might be okay with that. But if they're not, then they may well have to work a bit longer. They may well have to put more money into pensions and investments. But it's having that conversation. So it's not a last minute decision. I think that's the key. But right. Try to build up as much as possible in investments, pensions, and obviously the value of the business. Because the bigger pot you can have, obviously the bigger income you can draw from that.
So I suppose the key advice is don't plunder your business during the good years. Get financial advice early and start putting some money aside, which most people I think do. But you do get people who want to live the lifestyle and don't think about 20, 30 years hence, because when they start out, they think, well, I'm making £300,000 now and I'm 40. I'll be making £3 million when I'm 55. No, it doesn't always happen like that. Which leads me nicely on to the last question about what to do with the funds received. Do you find that clients are frozen with fear of squandering or losing their nest egg, and they're paralyzed? They just can't get down to making that decision what to do with the money?
Well, in an ideal world, we would be with them earlier, so it won't be an issue. We've already gone through all that situation. If we get, and obviously we do get some phone calls, people have just got a sum of money, whether it's from sale of a business, inheritance. If they haven't got experience of investing, there's an element of fear. Well, hang on, isn't it risky going into the stock market? But everything has risk. I always explain to people how leaving money in the bank is a risk. Even if we ignore the £85,000 limit that's in there, because that is a very low risk that something would happen to the bank if it's fully regulated in the UK, the actual risk is the inflationary risk, because the average inflation rate usually is higher than the average bank savings rate. So although it looks like your money can't go down, you actually need to dip into those savings year on year on year on year to buy the same things, which of course will then reduce your capital amount, and you can only get income from it. If you're investing in the stock market, which obviously we do for clients and all sorts of investments across different asset classes and across the world, that gives you the chance of beating inflation. That there's still income available, typically via dividends from shares. But generally speaking, the stock market goes up more than it goes down. There's no fixed return. It does go up and down the whole time, but you can have a look at average returns. And although it's not a guarantee of the future, and we know that, and that's our usual small print disclaimer that's on there. We don't know exactly what it's going to produce, but in the same way, property, you can't predict exactly what property is going to do. But generally speaking, if you can invest in the stock market for a long period of time, you'd be very unfortunate if it wasn't worth rather more than if you'd left it in the bank. You have the opportunity to beat inflation because the bank produces income only. It cannot grow. Stock market investment produces income and the ability to grow. as well, because it's investing in the economy, it's investing in businesses.
Great,
So,
very informative, Ray.
yeah.
Yeah, that's good. Fine, thank you very much for your time. As I said, everyone, if you want to have a chat with Ray's with Fairstone Group, we'll show you the details shortly. I'm with Henley Business Brokers. Always happy to talk to people, and I'm sure we'll be talking again, Ray. Thank you very much for that
Thank you, Norman.
informative interview.